Dear students, hope you all are fine. In my earlier video, I had discussed about the concept and elements of financial system in general. In this video, I will discuss about the characteristics of Indian financial system and will also provide an overview of the financial system of India since independence. First, we'll give an introduction of the Indian financial system. The Indian financial system is an important tool for the economic development of the country, since it helps in the creation of wealth by linking the available savings in the economy with that of investment. The financial system of the country facilitates the flow of funds from the savers, that is the households, to the investors or the business sector to help in the creation of wealth and development of both the household sector and the business sector. The Indian financial system can be broadly classified into formal or organized financial system and informal or unorganized financial system. The formal part of the Indian financial system comprises of the Ministry of Finance, Reserve Bank of India, Securities and Exchange Board of India and other regulatory institutions of the country. On the other hand, the informal part consists of individual moneylenders, groups of individuals operating as funds or associations, partnership firms, etc. Now we will discuss about the components of the Indian financial system. There are many components of Indian financial system. However, in this video we will discuss about the four main components of the Indian financial system. The first important component of Indian financial system is the financial institutions. Now, we have to know what is financial institution, what institutions are considered as financial, and what are the components of financial institution. So, now we will go to the discussion on financial institutions. So, when we talk about financial institutions, we can say that financial institutions act as mediator between the saver and the investor, or we can say that the financial institutions act as mediator between the investor and the borrower. The investors' savings are mobilized or used directly or indirectly through the financial markets or the financial institutions. So, we can say the main functions of financial institutions are the financial institutions can convert a short term liability to long term investment. This is the first important function of financial institutions. Then the financial institutions also help in the conversion of risky investment to risk free investment. This is another important function of financial institutions. Then again, the financial institutions can also match a small deposit with large loans and a large deposit with small loans. That is, it can act as a medium of convenience. The financial institutions can act as a medium of convenience. So, we can say that the best example of financial institution that we can give is that of a bank. Banks are the best example we can give for financial institution, since people with surplus amount make savings in their accounts and people with deficit amount of money or in need can take loan from banks. From the that means the savings of the surplus of the people with surplus amount of money are converted into loans for the needy people, and the banks act as an intermediate between both the savers and the borrowers. Then again we can say that the financial institutions can be divided into two types, that is banking institutions and non-banking institutions. So, banking institutions include banks and other credit unions, and this non-banking institutions include insurance, mutual funds, etc. These are the examples of banking and non-banking institutions. Then again, financial instruments can again be categorized into three parts, that is regulatory, that is we can say institutions that regulate the financial markets are RBI, we have discussed it in the introduction, IRDA, then again we can say SEBI, Securities Exchange Board of India, etc. Then intermediates we can say the commercial banks such as SBI and other banks, other commercial banks. Then non-intermediates include institutions like NABARD, etc. That means the institutions that provide financial aid to corporate customers, those are included in non-intermediates. Now we will go to the second component of Indian financial system, and the second component is financial markets. Now when we say financial markets, we can say that it is a marketplace where the interaction between buyers and sellers take place. Now financial market trades in money, bonds, shares and other assets related to money. So, the financial market can be divided into four types. The first one is capital market. Second type is money market. Third one is foreign exchange market. And number 4 is credit market. These are the four types of financial markets of India. Now, when we say capital market, the capital market deals with transactions which are taking place in the market for over a year. The capital market can also be divided into corporate securities market, government securities market, long-term loan market. That means we can say that the capital market is the long-term market. Then the money market is the small-term market. That means it is mostly dominated by the government, banks and other large institutions, and it is a wholesale debt market. The money market is a wholesale debt market which works on low risk and highly liquid instruments. Now we can divide the money market into organized money market and unorganized money market. Then we'll go to the foreign exchange market, and it is one of the most developed market across the world. The foreign exchange market is the most development markets across the world. The foreign exchange market deals with the requirements related to multi-currency, or we can say foreign currency. So, the transfer of funds in this market, in the foreign exchange market, takes place based on the foreign currency rate. And lastly, credit market, a market where short term as well as long term loans are granted to individuals or organizations by various banks and financial and non-financial institutions. That is the credit market. That means in the credit market, the individuals or the organizations can find various short-term loans and as well as long-term loans given by banks or other non-financial institutions. The next component of Indian financial system is financial instruments. The financial instruments are the products or the instruments which are traded in the financial market. So when we say financial instruments, we also imply that these are the financial assets of a financial market. Financial instruments, the important financial instruments are call money, that is when a loan is granted for one day and it is repaid on the other day, then it is called call money. And for this call money, no securities are required. Then second one is notice money. That means when a loan is granted for more than a day but less than 14 days, it is called notice money, and for this also no collateral securities are required. Then term money, when the maturity period of the deposit is more than or beyond 14 days, that is term money. Then treasury bills, also known as T-bills, more popularly known as T-bills. These treasury bills are government bonds or debt securities with maturity of less than a year. That means when we buy treasury bills, we lend money to the government. This is less than 1 year. Then certificate of deposits, CDs, we call this CDs, certificate of deposits. Now these CDs are dematerialized form, or we can say electronically generated funds deposited in the bank for a specific period of time. Then commercial paper. Commercial paper is an unsecured short-term debt instrument issued by corporations. So these are the important financial instruments of Indian financial system. So this is call money, that is it is for 1 day and repaid the other day. It is more than 1 day but less than 14 days. This is beyond 14 days. Then treasury bill, this is less than 1 year, and it is this deals with government bonds. Then certificate of deposit, these are electronically generated funds. Then commercial paper, unsecured short term debt instrument issued by corporations. The next component of financial system is financial services. The services provided by asset management and liability management companies are known as financial services. The financial services in India include banking services, It means or any small or big service provided by banks. The bank provides us various services like granting loans, depositing money, debit cards, issuing debit cards, credit cards, and various other types of account. These are the banking services provided by the banks in India. So, this is one of the important financial services provided in India. Then the insurance services. We all know that the insurance companies provide various types of insurance services like issuing of insurance, selling of policies, insurance undertaking, brokerages, etc. So, these are all part of insurance services. Then investment services. Investment services, these are mostly related to the investment function of the investors. That means it includes asset management. Then foreign exchange service. This is also a type of financial service provided in India. Foreign exchange services. Now, exchange of currency, foreign exchange, etc. These are part of foreign exchange services. So, we should all know that the main aim of the financial services is to assist a person with selling, borrowing or purchasing securities, allowing payments and settlements, and lending and investing. So, these are the important components of Indian financial system. Now, we will go to the characteristics of Indian financial system. Indian financial system helps in the economic development of the country through the creation of wealth by linking savings with investment. This is the first important characteristic of Indian financial system. That is, the Indian financial system plays an important role in the economic development of the country by creating a link between savings and investment and by creating wealth through this link. The next characteristic is that the Indian financial system facilitates the flow of fund from the household sector to the business sector. The Indian financial system is mainly classified into two types, that is formal or organized and informal or unorganized. The formal part of the financial system is controlled by the Reserve Bank of India, while the informal part mostly formulates their own rules. The financial system of the country encourages savings and investments among the savers and investors of the country. The financial system of the country provides opportunities to the banks to allocate the funds in a proper manner. Now, I will provide an overview of the Indian financial system. As we all know, and we have also discussed in our earlier slides, that the economic development of a country depends largely on the efficient functioning of a financial system. The growth of the financial system of a country is an indicator of the economic development of the country. Since independence, the Indian financial system has undergone drastic changes in its structure. The changes in the Indian financial system can be classified mainly under three heads. So, the first stage we can say that is pre-independence, that is before 1947. The pre-independence financial system of India was totally unorganized and very few securities were traded in the securities market by the capital stock exchanges. As we all know, Before 1947, India was under the rule of the British government. So, the pre-independence financial system was not in a good state, and so it was totally unorganized and very few securities were traded. No separate issuing institution existed, and there was no participation of financial intermediaries in long-term financing of industries. The access to external savings by the industries was also strictly restricted. In short, the financial system of India during the pre-independence period was highly incapable of achieving the required rate of economic development in the country, especially in the growth of new and innovating enterprises. So, the pre-independence financial system of India provides a very gloomy picture of the financial system of the country, and the economic development of the country also suffered as a result of this unorganized and inefficient financial system. So, the next stage was the post-independence period, that is from 1947 to 1990. The post-independence period emphasized on planned economic development of the financial system. During the first phase, the 5-year plans were introduced in the country. The Indian economy provided equal role to the public sector and the private sector in order to achieve industrial growth and development. Huge development took place in the financial system during this period. The second phase of the post-independence period gave importance to the transfer of ownership from private sector to the public sector and also setting up of new institutions in the public sector. The entire share capital of the Reserve Bank of India was acquired by the central government when it was nationalized through the Reserve Bank Act 1948. The process of transfer of ownership from private to public sector continued through the setting up of State Bank of India, nationalization of life insurance business, nationalization of commercial banks, nationalization of general insurance business, and so on. These transfer from private to public sector continued with development of financial institutions, investing institutions like UTI, LIC, etc., and other institutions like Export Import Bank, NABARD, etc. The role of the commercial bank was also gradually changed from merely accepting deposits and financing short-term needs of trade and commerce to underwriting of issues of capital and lending term loans to the industrial sector. These developments in the commercial banking sector brought significant changes in the financial system of India. Now we will go to the next stage of the Indian financial system, that is the stage 3, that is post liberalization period after 1990. The financial system of the country went through a massive change after the implementation of the new economic policy in 1991. The adoption of this policy has transformed the Indian economy from closed to open economy. Some of the major developments that have taken place in the financial system of India after the adoption of the new economic policy are the entry of private sector, changing role of development finance institutions, emergence of non-banking financial companies, growth of mutual funds industry, establishment of Securities Exchange Board of India, or we can say SEBI, developments in the stock market, and so on. So, this is an overview of short overview of the Indian financial system after independence, before independence, and after the liberalization period. So this is all in that we have included in this video. In case of any doubt, any query, you can always contact me in my number. Thank you very much for watching my video.